Hi, I'm Dean Orrico at Middlefield, and I'm happy to be joined today by Jonathan Gitlin, CEO of RioCan REIT. We've owned RioCan in our Middlefield portfolios really since the company IPO'd in the mid-1990s, and it's been a perfect example of the type of company we want to own in a Middlefield fund because it regularly pays and has grown its distribution over time. Jonathan joined RioCan in 2005, and he's been instrumental in reshaping the company's portfolio, including managing its secondary market disposition program, as well as building out its residential portfolio, better known as RioCan Living. Today, RioCan's portfolio of assets includes some 200 properties across Canada, with over 90% of its revenue coming from Canada's 6 major markets, and in fact, over 50% of its revenue coming from the GTA. Jonathan, thanks for joining us today.
Thank you.
So let's get into it, Jonathan. As we look at 2022, no surprise, we know it was a tough year for REITs generally. We know in Canada, they were down in kind of the mid-teens and more than that in the US and even globally. And when you think about the real estate market, most of the attention and the positive commentary is coming around industrial or multifamily. But when you look back at 2022's returns, in fact, the retail-focused REITs were the best performing part of the market up here in Canada. Why do you think that was?
Thanks, Dean. First of all, great to be here with you. And I would address that question by saying that there's been a very slow forming recognition that some of the same attributes that helped prop up the industrial and multi-res sectors in the prior years is starting to fall on retail. COVID did a lot of bad things for retail, but what it cemented was that really no new supply was brought onto the market, and there was a significant need for brick and mortar space. And what this has created, slowly but surely, is a supply constrained environment. And that's obviously a tailwind for retail landlords. And while investors have long viewed industrial and multi-res as having that tailwind, and it was very acute, and it is absolutely the case. I mean, we are undersupplied from a multi-res perspective, and we're playing significant catch up from an industrial perspective. There's been this long view that I would say was supported by some negative press around retail, that there's too much retail in Canada, that there's no need for retail now in the face of e-commerce. And I think what COVID did was brought into light the fact that, in fact, brick and mortar retail is essential to the overall ecosystem of, consumer ecosystem. And all of a sudden, there's this recognition that in Canada, along with all the immigration that's supporting this need for brick and mortar retail, that the tenant demand for retail space, particularly where RioCan owns it, which is in high demographic, highly populated urban areas or suburban areas, there's really just a lack of supply. And so that same dynamic that has supported those other two asset classes is now being recognized as a support for RioCan. As I said, it's been a slow recognition, but I think as our results start to show, there is definitely an outsized demand for a limited supply of solid open-air retail space.
So that's a good segue, Jonathan, because I recently heard you say that for the second consecutive year, you're seeing one of the lowest incidences of tenants restructuring or just generally struggling in many, many years. So do you attribute that to an economy that maybe isn't yet slowing, or would you say that's more just the retail leasing market being on its strongest footing that you've seen in many years?
So it's interesting. Earlier today, actually, I had my team put together some statistics. This is in advance of our quarter and year-end conference call that we're having next week, just to address that very question about what kind of fallout we've seen in January of 2023 relative to January of 2020 and 2019, which you could argue were the last of the stabilized years in retail before government programs kicked in and before COVID kicked in. And it was actually astounding in the sense that the fallout this year was de minimis, and it was much lower than it had been in those prior years, which were arguably very strong years in retail. And so the question you ask is, why? What's going on here? Is it just a laggard effect on the economy, and will our tenants ultimately feel some pain? And I think for the case of RioCan, where we do cater to a lot of tenants that I'm not going to say are impervious to economic downfalls, but they are durable. They are value-based tenants. They are tenants that do help with day-to-day needs. I don't think an economy or an economic downturn, no matter how deep it is going to have a dramatic impact on those tenants. And I do think that, going back to the response that I gave you earlier, Dean, there is a limited amount of retail space, particularly where RioCan owns its shopping centers. And retailers are loath to give that up. So even if they have seen a little bit of short-term weakness, they'll do what they can to hang on and to keep that space, because the long-term prospects of it are significant for them and they really add to their overall business plan. So we're seeing a lot of those tenants just kind of muddle through maybe what might be a little bit of softness. But the truth is, a lot of our tenants are performing very well. And we're hearing that from all different types of tenant classes. And so we expect it to keep up. So you're right, the economy's slowing. There will be some latent impacts, but from the perspective of RioCan and its tenants, we do actually see some good health within our tenant base for this coming year.
And is there any particular tenant group or profile that you think may be more vulnerable than others? If in fact we do see a real slowdown?
Yeah, now at the risk of sounding Pollyanna, I think most of the categories we cater to are going to do well in any kind of economic backdrop. We've been very thoughtful about the types of tenants that we've put in place. And a lot of the tenants that would have been susceptible to an economic downfall, again, going back to COVID, one of the very limited good effects of COVID was it did allow us to weed out a lot of weaker tenants. And a lot of those were, call it mid-level apparel tenants, who have historically struggled in the face of an economic downturn. People then revert to either, if they have a lot of money, they revert to luxury. If they don't have a lot of money, they stop buying clothes or they go to sort of cheaper alternatives. And so that category was really dealt with throughout the course of COVID. But if I look at across our categories, we've tried very hard to enhance the strength of our tenant base, and we've labeled or categorized our tenants as strong and stable, or traffic drivers, compelling traffic drivers. If I look at strong and stable, that makes up about 86.5% of our overall revenue. And what characterizes a strong and stable tenant is either a remarkable use coupled with a very strong balance sheet. And what characterizes a significant traffic driver is a phenomenal use, but maybe not having the best balance sheet. I think in that first category that represents 86.5% of our overall portfolio, I'm not that worried about them in a recessionary environment. The second category, however, there's going to be some tenants in there that might not have the balance sheet to withstand some sort of slowdown, and we might see some fallout. Smaller gyms, smaller restaurants, things of that nature. The other interesting thing I'd say is, the obvious answer to the categories that could struggle in a recessionary environment are sit-down restaurants, some of the mid-level to higher-end restaurants, which we do cater to in our portfolio. But I read a Jones Lang LaSalle report actually this morning, which talked about the grocery and restaurant landscape in North America, not just Canada, but usually what happens in the US is a pretty good indicator of what's happening in Canada. And the stat was that in the latter part of 2022, the restaurant spend, sit-down restaurant spend, had outpaced grocery spend. And so it's interesting to see that people have not stopped, even with this kind of fearful environment of what's going to happen with the economy. They have not stopped spending at restaurants. I don't know that that's going to go on throughout the year. Right. I don't know how sustainable it is, but it was an interesting stat nevertheless. So I think generally across RioCan's portfolio, there are not a lot of weak links when it comes to categories of tenants. But as I said, smaller gyms, some smaller restaurants, that's where you'll probably see some pain.
So let's switch gears here and talk about growth. Now, we know that developments have played a big role in RioCan's growth over the years. How should we think about development completions and spending over the last few years? And as a related question, how have the slowing housing markets informed your view on whether you're going to do more in condo or rental?
We've set an objective with respect to developments, and that objective was spending somewhere around $400 to $450 million annually on new developments. We feel that this was supposed to be an objective that was durable, that was supposed to withstand any kind of economic backdrop. Most of our developments are mixed use, so a lot of residential goes into those developments. There's always going to be a retail component that marries with the residential. We think it's a great combination of uses. And we still feel that no matter what the backdrop, it is important. It's an important aspect of our growth story. It's one that differentiates us, and it's one that we can afford to do. We've set our balance sheet up in a way that we don't have to raise equity in order to fund this level of commitment to developments. And while there is some short-term drag, there's long-term benefits. And actually 2022 marks the first year where we've seen the real results of that commitment to development many years ago. We have more development deliveries than we do spend, meaning that we've created value of around, call it $700 million in 2022 relative to a spend of $400 million. And that's taken us a long time to get to. And it's that delivery of that $700 million of value that will really enhance our growth prospects. So while there's a lot of sacrifice involved in development, we're now seeing the fruits of that labor. With respect to the second aspect of your question about the mix between multi-res rental and condo, we look at everything. First of all, I think there is a housing crisis in Canada, particularly where we build and on transit. So
Shortage of housing.
Shortage of housing, absolutely. And I think that will inform a lot of our decisions, because even though the current dynamics might not be ideal with heightened interest rates and inflation hitting a lot of the costs that go into building some of these mixed-use developments, the long-term value of those is I think remarkably robust, and I think we're going to see a lot of that play out over the next little while. And so, but to the specific question, the balance between rental and condo, we look at every project on a singular basis, and oftentimes we have enough density where we build more than one building. So we'll have 2 towers, 3 towers, whatever it might be. We look at the market absorption that's logical in that area. We build as much multi-res as we think can be absorbed, and then the rest will typically be condo. The condo will typically help us pay for the multi-res, and in this environment where everything slows, we look at everything through an IRR lens, and if we know that the condo simply won't sell or won't be successful, that probably means that the IRR hurdle will not be met, and we'll just pause on that development until the conditions are appropriate for us to go forward. And just finalizing that and closing the loop on it. For RioCan, where we've got active and very functional shopping centers on these development sites, it doesn't hurt us to wait. So that's what we're doing now.
Interesting, and that's pretty much describes the current environment where there's maybe a bit of a pause and kind of see how things shake out. Is that fair to say?
Yeah, not on every project, because some still do cross that hurdle
Right.
From an IRR perspective.
Right. The TSX Canadian Dividend Aristocrats Index recently lost 2 REIT constituents. I think it was Smart Centers and Slate Grocery. Now, last year, you guys announced your first distribution increase in many years, and I'm wondering how much of a priority that is, because if I understand it correctly, the index requires 5 consecutive years of dividend bumps before you can be considered for inclusion. What are your thoughts there?
So Dean, at our Investor Day that we held last year, at the beginning part of last year, one of the, we laid out a 5-year plan, and one of the focal points of that was what we're going to do, what our payout ratio objectives are. And going back to the discussion we had before about use of capital and funding our development pipeline, another objective was continuing that development pipeline, but not doing anything that would sacrifice our balance sheet in order to keep it up. And the principal tenet behind that was being able to utilize our own capital and retained earnings. So we set a target of retained earnings or payout ratio of 55 to 65% of FFO. And our view was that as long as we can stay within those parameters, we would like to reward our shareholders. And we know that we have a large retail shareholder constituency that very much favors dividends, and we appreciate that. And so our view was that, one, it's our board's discretion, but as long as we can show the board and the public and our investors that we can stay within those parameters of retained earnings and stay within the 55 to 65% payout ratio, then it would be our objective to continue to provide a consistent and sustainable dividend increase year over year, provided all of those things flush out. So my answer to you is, as long as those parameters are in play, it would be our objective as a management team to recommend to our board to continue to reward our shareholders, but only if those parameters continue to be in place. So I would like to be a part of that Aristocrat index, but it's still, I guess I got a few years left.
Yeah, you got a few years to go. Yeah. Well, this was excellent. Thank you, Jonathan, and thank you. And if you need any more information about Middlefield or our funds, please feel free to visit our website, middlefield.com. Thank you.
Thank you.